and enjoyed working with. Some others enjoy to do the shopping around to find the perfect lender, or if they're looking for the perfect rate or a cost structure itself. And once you have that ironed out, it never hurts to get a pre-approval where you start looking at the numbers, credit, you get your debt to income information out of the way. So then it makes it a little smoother process down the road, where you just have the appraisal and title work left to kind of finalize things before closing. I guess, and what do I need to start this process? To start the process, I would touch base with your mortgage lender. Once you find where you want to go and who you want to work with, they're a great source of information to answer any questions you may have about the process itself. And at Prevail Bank, we have an online application process, but if that isn't comfortable for some borrowers, we do meet face-to-face in the office too, to do the actual paper application and things like that. If you don't want to do things on the internet or on the computer, some people aren't comfortable with that, and that's totally fine. And I'm sure that these options are very common with most of the financials in the area, unless you're working with an online broker where the majority of their options are strictly online. So that's where I would start.
Okay. So if somebody is just starting to think about finding a lender, what questions should they ask? What should they do in that research process? What should they be asking about and knowing before they make a decision as to who they want to work with?
Sure. Some of the things that I would be on the lookout for are, do they have competitive interest rates? Are you getting locked in on something, low and comparable to a lot of the competition in the area? Do they offer the term or loan structure that is what you would prefer? At Prevail Bank, we have a one close option, and where your interest-bearing construction phase automatically rolls into your permanent financing after the fact. Some financials do offer a two close option, where your interest phase, you close on your interest phase and then you build your home and then you close on your permanent financing after the fact. Some people like that because you can change your interest rate, lock in at different ones, but then there's also additional costs associated with that as well. Other things that I would look for are comparable or fair closing cost structures. Do they have technology-based or online applications? Do they do the in-person paper applications? Are they knowledgeable, and do they have a personality that works for you? I definitely think if you're working with something so confidential like your mortgage and your credit, that you want to be working with somebody that you like and that you trust.
Can you talk a little bit about how the relationship is different with a construction loan then? Because sometimes with a mortgage loan, you only see the lender, once or twice. Can you just talk a little bit about how construction financing works and why that relationship is so important?
Well, construction financing is a little bit more in depth because it's a longer process. You don't just deal with them in the one-time purchase aspect. It's throughout the whole draw process, which can be 6 to 12 months, depending on how big the project is. So there's definitely got to be a level of trust and that you think that they're doing things fairly and that you aren't going to be left behind in the process, that they're talking you through everything and making sure that everything's in line as the process is going along. So when you come to the end of your project and you have your home, that you feel comfortable how things are going to progress after the build is completed.
Okay. So then can you talk a little bit about construction financing in general and what is, the process for construction financing? How does that work? And how does that differ based on how you purchase or how you build a house with a lot?
Sure. Well, construction financing has two main parts. There's an interest-only building phase and a regular permanent financing phase. Usually the interest only can last about 6 to 12 months, like I had said before. During this period are when draws and inspections are made with the title company to ensure that funds are being utilized for the corresponding allocated costs as the house comes together. Normally, longer interest only periods have a little higher cost just to extend that period out. Um, Interest accrues during that period only on funds that have been advanced to the loan on a monthly basis. So you're not paying interest on your full loan amount if you've only utilized, one draw and a small draw at that. After the building is completed, the loan will move directly into your regular financing. I don't like to say fixed financing because some financials may have adjustable rate options for your regular financing after the fact, which wouldn't make it fixed per se. At that time, your loan would run just like any other mortgage loan with principal and interest payments outlined by your note, which is gone through at closing. On the rare occasion, there are leftover funds available that were not advanced or utilized for the full build out. Normally on our basis, we would apply that towards your principal to chip away right at that right away for you. Let's see. With our one close option, your interest rate is locked in and set with closing. Interest will accrue at that interest rate throughout the interest only and then your regular financing phases. And fees should be outlined prior to closing with your loan estimate and your closing disclosure, just like any other regular home purchase or refinance. So there shouldn't be any major surprises or anything like that that isn't outlined throughout the process for you. And then I was going to chit chat about the difference in the scenarios between purchasing a completed project directly from the builder, buying the lot and building later, and then buying a lot and building now, if you wanted to go through that right now.
Yeah, definitely.
Okay. So the difference in financing for those options. So the first one I wanted to chat about was buying a completed new build property directly from the the builder, sorry. As a financial institution, we would work on this credit application as a regular purchase. But there are some benefits to the borrower to get into a property in that phase. Like getting to customize some aspects of the build with the builder as it's being completed and being put together. And I'm sure Adam Ashley will delve into that a little bit next week. If you chose to buy the lot and build later, some customers aren't at the point that they want to build quite yet, but have found the perfect property that they wish to build on in the future. And at that time, we would focus on a lot or land loan to finance the purchase of that, or a customer could pay cash if they had it on hand. And that would turn into an added asset towards their final goal of building a home down the road. So in the meantime, before constructing the property, the customer is building equity into what they want to do down the road. If this property would be paid off or chipped away down prior to building, it's equity towards your property. So ultimately it could alleviate some of the down payment pressure down the road once you're ready to build. If you chose to purchase the lot and build all in one, the timing is key on that transaction type because building can't technically start until the borrower actually purchases that property. A down payment is still required, but the land being purchased would then be factored into the appraised value with the dwelling that they plan to build. Oh yeah.
Okay. And so what, one more question for you right now too. So what type of down payment do you typically need for a construction loan?
Normally on a construction loan, we're looking at 20% down. And that's either on the appraised value or the cost of the construction, whichever is lower.
Okay. All right. I will also add for those watching on Facebook too, if you do have any questions as we go, feel free to type them in. We are monitoring and we'll answer questions throughout this as well. So if you're watching, you have questions, please feel free to type those in, and we will try to do it, and we will do our best to get those answered. With that, then I'm going to switch over to Nightberry, and could you guys tell us a little bit about what the role of the title company is in a new home?
Sure. So title insurance is a product that, we issue a title commitment, which does a search of the public records for current owners, liens out there against the property, mortgages, judgments, child supports, tax liens, stuff like that. And then we close off of a commitment to get to the policy. And to get to that, we work with the lenders to coordinate with the closers and go through the numbers. So our role would be to, Katie would send us an order for a cost to build, and then, figuring out what the appraised value, what kind of value was on there that she wants to insure. I did want to talk about the lots. She said buying it from a builder, buying the lot, or buying the lot and building. So obviously, when you buy the lot and the house from the contractor, you're going to get insured. We offer insurance, right? That we're in title insurance. So you're insuring it to, let's say you bought it for $350,000, and so you're getting insurance for $350,000. A lot of times we see people buy the lot for, let's say, $50,000, and they're going to build later, and then that's a question that a lender should ask their customers, like, well, you have an owner's policy for $50,000. Do you want to insure it up to the $350,000 for the new cost to build? And a lot of times they do, and a lot of times they don't, but it's definitely, you don't want to underinsure yourself, just like you wouldn't want to underinsure yourself on insuring your homeowner's insurance or hazard insurance. You wouldn't insure your $400,000 house for $50,000. It's the same thing. So from the standpoint of the closings, like I said, we like to get the cost breakdown from the builder, the loan officer, work on the closing disclosure with the lenders, balancing, make sure we have enough funds to close it and build the project through. And if there's changes, address those as they go. So, and then our role would, as a title insurance, is to, to keep that lender in that first lien position, that they have the lien out there against it, and keep it that way. So,
can you guys talk about the role that the title company plays between the lender, the builder, the contractor, and how that works?
I think for me, the easiest way to describe that is think of it as a triangle. So the points of the triangle are the homeowners, the lender, and the general contractor, the subcontractors. We sit in the middle of that triangle as a communication source between everyone that's involved with the project.
Okay. So how does the draw process work then?
The process, your builder is going to put together what they call a draw request. That will need your written approval before that draw moves any further along in the process. So normally a builder will sit down and go through the draws with the homeowner, have the homeowner sign an owner's authorization that approves that draw request. Once we receive that at the title company side of things, we'll do what's called a progress inspection. So we're just going to go out, we're going to take pictures, we're going to fill out a little checklist, just look to see what's done compared to the items that are requested on the draw. And then we are going to, once again, Brent talked about doing that search. We're going to do that search every time that you do a draw request. So we're going to search for liens, judgments, make sure, let's say if you bought a lot in a subdivision and that subdivision was refinanced, make sure that your lot is not part of that new refinance. Things like that have come up in the past, and it's just a simple matter of getting it cleaned up so it doesn't affect your title in the end. So we'll do a check like that again each time that you do a draw. Then we're going to send all of that information, the pictures from the inspection that we did, to the lender for the lender to review. And we're going to put together a spreadsheet that they're going to look at so they can see where exactly the project is in terms of that original budget that we started. Is there anything under budget? Is there anything over budget? How are the financials looking also? and then the lender will approve it, and they'll fund to your title company, and then we would fund to the builder or to the builder and the subcontractors, however it's determined between the lender and the builder and the homeowner.
Okay. So really, you're the one making sure everything's being done, I's are dotted, T's are crossed in the whole process, correct?
We're the eyes, yep. We're taking a look at everything and we're trying to get everything put together before we send it to the lender to make their lives a little bit easier, make sure that the homeowner knows exactly what's going on. So that's why we require that written authorization, try to take the surprises out of the project.
Okay. And so then what happens, so can you talk a little bit what a lien is? So let's say the builder doesn't pay one of their subcontractors and that subcontractor can put a lien on the house. What does that mean in this process, and what does that mean for the homeowner?
So a construction lien is a way for a builder or a subcontractor to protect themselves on a project to make sure that they are getting paid. A lot of times people view it as a very bad thing. In where I'm from and where I sit, it's not such a bad thing. Because if there is a dispute, there's usually a dispute that causes this lien to be filed. So when that lien is filed, it's out in the open then. Everyone has a chance to address it. The lender knows about it. The homeowners know about it. It can be addressed and it needs to be addressed. Whereas if that lien doesn't get filed, there's just those bad vibes going on throughout the project. So basically that lien says that, hey, we did work on the project and we didn't get paid. We're looking for payment in the amount of, and a lien has to have an amount on it. It can't just be, an open, hey, today you owe us $5,000, tomorrow we're gonna say you owe us $20,000. There's gotta be a dollar amount on that. Interest can be involved in that, but that will have to be figured out. And there's a couple ways that it can be figured out. The homeowner and the builder can sit down and work these things out together, or sometimes they do wind up getting lawyers involved. Sometimes the lawyers will sit down and the two sides will figure things out before it goes to court. Sometimes it does get to the point where it does go to court.
Okay. Let's see here. Oh, looks like we've got a question that came in. So all right. So, so one of the questions that come in, if you have a lot that you plan to build on that is paid off, can you use any of that as equity, or does that help with financing the building part of the loan in any way? Katie, can you talk about that?
So if you have a lot that's completely paid off and that's the property that you are utilizing to build on, is definitely factored into the appraised value when the appraiser puts everything together with your specs and your plans and your blueprints. That equity is factored into that end valuation, which then we would figure your loan amount off of. So it's equity that's built in just on the valuation side, as long as it's the property that you're building on. If it's a completely separate, parcel of land that you wanted to utilize as additional collateral, you could do that too. But then your closing costs are going to go up because you're going to have two dwellings, two parcels, which result in two appraisals too.
So basically, by putting that in the equity, it helps reduce the, it would help count towards the total amount of cash in, correct? Right.
Yeah, that would chip away, if not take care of your 20% that you would be looking to put into the project.
Okay. So then once we go through the process we've built the house, we've done all the draws, the title company has done their work, we're at the home is ready to close, or the home is ready to move into. What's the process once the house is completed?
Well, once the house is deemed completed, we can cut out the final draw funds, because as a financial, we don't want to fully deplete your loan funds until the project is finished. With that one close option, it really is rather seamless, and automatically it rolls into your permanent financing. So instead of receiving interest payment invoices each month based off of how much interest has accrued, you would then utilize your loan booklet to start making your regular principal and interest payments each month. Or at that time, you could look at, if you didn't want to keep remembering to make your monthly payment, you could set it up on automatic payments at either your minimum payment that's due every month, or you could do a little bit more to chip away at principal, whatever you felt like.
Okay. All right, so another question that I have, so we talked about the down payment and what you need to get the house started, but a lot of times when you're building the house, you're making decisions, and when the builder's bidding out a house, they're bidding it out based on, you know, what they're anticipating, what you're going to spend on flooring and countertops and irrigation, or what might go into that. But as the homeowner is finishing that house, you may make different decisions as to, you know, picking a more expensive flooring, or deciding to upgrade to granite countertops when you had been originally planning on laminate. How does that impact the loan and the building process?
So this happens a lot, where throughout the process things change. It happens, you know, you're building your house, you want it to be exactly what you want. However, if these changes are made to the plans after an appraisal has been completed, that change in valuation can't really be factored in. So then we utilize the spreadsheets from the title companies to gauge overages or shortages in each allocation throughout the project. So sometimes, you know, we look at it as a case by case basis. So if you come in with a draw that has an overage in, say, flooring, because you wanted to do something different than was originally planned, we would look at that overage amount and see if there was a shortage somewhere, because sometimes permits don't cost as much, or if you decided to go with different lights that were cheaper, but you didn't utilize all of the allotment for something else in the project, then we would definitely push through an overage in something else. But that's why it's a case by case basis, because if you're doing an overage throughout the project, you know, we may request that the customer bring in a little extra cash for that draw to make it go through to cover that overage, or some lenders may be more trustful and just ask that the customer bring more cash in at the final draw too.
All right.
I think can I jump in here?
Go
I think
for
there's
it,
a few different ways that can be handled too. And I know Katie talked in the beginning about, you know, making sure that you have a trusting and comfortable relationship with your lender. Overages is a really great question to ask your lender about, because on our side of things, several different lenders handle it differently. There's some lenders that will fund them as they go along in the project. There's some lenders that will not allow you to change the allocation of those funds like Katie was talking about. And there's some lenders that do let you reallocate funds within a project. So asking your lender how they handle overages is a really great question. And again, takes that surprise element out when you get to that point down the road. It's also really great if you can get to the point where you've got a little cushion built into your loan to cover some of those overages. That used to be a very popular thing, and then it kind of trended out. We're kind of seeing it come back again, where there's a little cushion built in to cover some of those items. If they're not used, it's not used. Again, principal reduction. But it is nice to just have an idea in your head going into your project how those things will be handled.
And I know Adam probably will touch on this a little bit next week too, because he usually talks a little bit about this too, but I know just planning to have some extra cash on hand is a good plan when building a house. You don't want to be down to the last dollar, so to speak, with your down payment. So
agreed.
So that leads us right into the appraisal and how the appraisal works with new homes, because I know sometimes that can be a challenge, and what happens if the home doesn't appraise for the value of the loan.
Well, on a construction, the cost to build can be a little skewed by inflated building costs, where the value of the projected property comes in less than the cost it actually takes to build it. And we see that, you know, with lumber nowadays is a little inflated, and things, you know, get those guts put together. In this case, as a lender, we have to go by the lower of the appraised value or the cost to build to come to our loan to value. So if it doesn't appraise out per the cost structure, we would have to either bring in additional collateral to cover that shortage. If you had something else that was an asset like additional land owned or a cabin home or something that you could tack on to bring that valuation up, or the customer would need to bring in more money. Since we could only go up to 80% of that appraised value, the customer would then have to cover the additional costs that would be associated.
All right, so we're kind of wrapping up here. If there anybody else watching has any other questions, please type those in now. If there's any other questions that you have, do any of you guys have anything else you'd like to add that we have not covered today that you wanted to make sure we addressed?
I think I have a couple things. Just Katie talked earlier about, interviewing your lender, making sure you have a comfortable relationship with your lender. I also think it's important to interview your builder and have that comfortable relationship with your builder. Each builder has a little different working style. Each builder has a little different billing style. So for example, we did a house for a gentleman who was an accountant, and his builder, up until the final draw, everything was nice round numbers, because that's just how he has always done his billing. If you're a to the penny person, round numbers on your invoicing is going to drive you crazy. So just kind of think about those things when you're talking to your builder, and what that comfort level is going to be, and little things like that that might throw that comfort level off a little bit. Nothing wrong with how this person billed, nothing wrong with how they built, just a little different relationship piece of the puzzle there that made it a little uncomfortable for the homeowner. So think about things like that. The other thing that I did want to touch on is builder profit. Just like we go to work every day, when the builder comes to the job site, that's their job. That's where they're going to earn their living. They are going to need to have a profit on the job in order to keep their business going. So a lot of times we get questions on, well, is it okay for them to add profit to this? And I just want to make sure everybody thinks about that when they're doing a construction project, that this is how they earn a living. So there is going to be a profit margin involved there so that they can continue to earn a living doing this.
That's a good point, because I've had a few people that have called our office too with questions on that and what's standard. And I know different builders will list that differently when they're going through the process. Some list it out, some just will increase cost of materials to cover, there's different ways that the builders will list that or include their profit. And so, but there is a markup for that somewhere in the billing process.
Yes, absolutely.
Did anybody else have anything else they'd like to add?
One thing I wanted to add, just like in any other home purchase, a lender is going to require that you have proof of homeowner's insurance. And just because in the building process, you don't technically have a home yet, but there is still a type of insurance that your lender is most likely going to require, which is called builder's risk insurance. So that covers the buyer or the owner in case anything were to happen on their property while their house is being built. And most insurance companies are fully aware of builder's risk insurance and have that for a period of time and can easily roll that into your regular homeowner's insurance after the building is complete.
Good point.
I was just going to talk one more time about that lot and buying the lot, building owners. So increasing it to the, to the value of the property. There, from the title standpoint, there's a significant discount if you already have an owner's policy, that you can just increase an owner's policy, stuff like that. So yes, it will cost more than just doing a loan policy with Katie at the bank, but it will be cheaper than if you just took out a whole $350,000 policy, for example. There is a discount by having that owner's policy that you already got when you purchase a lot. So, and it's a pretty easy calculation to come up with that. So it's something to definitely think about.
Okay, good. All right, anything else? All right. Well, I want to thank all of you guys for participating today, to Katie, Jody, and Brent for all being a part of our first virtual ABCs of Building a Home Facebook Live panel. So this is our first time through this, and this video will be available for anybody to view later on Facebook. Also next week, like I said at the beginning, we will be doing part 2 with the builder, Adam Ashley with Ashley Construction will be joining me on Wednesday next week at 5 p.m. and we'll be getting his perspective, the things you need to know from the builder's perspective if you're going to be building a house as well. So thanks, everyone.
Thank you.
Bye.
All right, we're off live. All right, thank you guys.
All right, thanks.
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 Bye.
Bye.